Let's talk about the American dollar, the thing you work for and the thing that buys you less every year. In 1913, the Federal Reserve was created to stabilize the economy and manage the money supply. The idea was safety and predictability, but the result? The dollar's value has plummeted. What cost $1 in 1913 now costs over $30. The Fed was supposed to protect our currency, but inflation has been the norm, not the exception. It's like a magician promising to guard your wallet, but your cash keeps disappearing. The system was designed to expand the money supply, making your dollars worth less over time. The Fed became the referee, but the game is rigged. Your money will always buy less tomorrow. The creation of the Fed didn't just change our money, it changed our trust in banks centralizing power and creating a wobbly foundation. The promise was safety, but the reality is a slow-motion crisis with the Fed presiding over the dollar's decline. For decades, Americans believed their money was safe in banks, reinforced by the FDIC's promise to insure deposits. This trust kept the system stable, until the savings and loan crisis of the 1980s shattered the illusion. Hundreds of S&Ls failed due to risky bets, and the government's bailout cost billions. Suddenly, people realized banks weren't just holding their money, they were gambling with it. The FDIC's safety net had limits, and the public saw that their deposits weren't sitting safely in vaults. The 2008 financial crisis drove the point home. Even massive banks can collapse overnight. People lined up outside banks, desperate to withdraw their money. The message was clear: no bank is too big to fail, and government promises aren't ironclad. The belief in absolute bank safety was replaced by anxiety, a justified fear. Trust, once lost, makes the whole system fragile, and that fragility is now a permanent feature of modern banking. When anxiety turns to panic, you get a bank run, the financial version of a crowded theater stampede. A rumor starts, people rush to withdraw, and the bank simply doesn't have enough cash. Banks only keep a fraction of deposits on hand, the rest is loaned out. When everyone wants their money at once, the system collapses. Silicon Valley Bank in 2023 proved this. A digital bank run wiped it out in 48 hours. The FDIC insures deposits up to $250,000, but most of SVB's clients had far more at stake. The safety net was too small, so panic spread. Bank runs aren't rational, they're contagious, self-fulfilling prophecies. Even a well-managed bank can be destroyed by fear alone. Once confidence breaks, withdrawals force banks to sell assets at a loss, making things worse. The system fails not just from bad management, but from the collective realization that the game is rigged. In banking, panic is always just one rumor away. Why is our system so fragile? It's called fractional-reserve banking. You deposit $1,000, but the bank keeps only a fraction, maybe $100, and loans out the rest. That money gets redeposited and reloaned, multiplying across the economy. On paper, it fuels growth, but it also creates a pyramid of debt balanced on a sliver of real cash. If everyone wants their money back at once, no bank can pay. The system survives only if we all trust it blindly. It's legal, but it's like juggling chainsaws. One slip and the whole act collapses. Even the best-run bank can fail if its competitors make reckless bets. Banks are interconnected, lending to each other, investing in similar assets. If one bank collapses, panic spreads, and healthy banks face runs too. Interbank loans go unpaid, and asset values plummet as banks sell in a panic. This domino effect can take down the whole system. In 2008, Lehman Brothers' failure sent shockwaves through every major bank. Unlike other industries, one bank's failure hurts everyone. In banking, a single sinking ship can drag the whole fleet down. The system's strength is only as good as its weakest link. The FDIC is supposed to be our safety net, but let's look closer. Banks pay into a fund to insure deposits, but the fund is tiny compared to total deposits. About 1.3 cents for every dollar insured. In normal times, it's enough. But in a crisis, the fund would be wiped out instantly. The FDIC's real power is psychological. It keeps you calm so you don't panic. If multiple big banks fail, the fund is gone before lunch. The government could borrow or print money to cover losses, but that's just another illusion. The FDIC isn't a vault of gold. It's a sticker on the door and a hope you won't ask for your money all at once. When confidence breaks, the FDIC's magic trick fails. If the whole system melts down, the government's only option is to guarantee every deposit, by printing trillions of new dollars. That's what happened with Silicon Valley Bank. The government made everyone whole, no matter the limit. But printing money to save banks risks hyperinflation. Your savings are safe, but now worthless. We've seen this in Weimar Germany, Zimbabwe, Venezuela. Saving banks by destroying the currency is a disaster. Is there an alternative? Some economists propose 100% reserve banking. Banks keep all your money, lending is separate and explicit. No more bank runs because your money is always there. It's a system built on reality, not illusion. It might be less exciting, but after decades of crisis, boring might be exactly what we need. In the end, the real magic trick is convincing us not to look too closely at the system's foundation of air. Thank you for listening. Please tell your friends, like and subscribe.